Hi everyone, and welcome to the new episode of our Blockchain Brown Bag Meetup series. If you're new here, I'm your host Alik Talipov, and this event is brought to you by the Blockchain Professionals community. We are kind of think space of blockchain enthusiasts, of blockchain engineers who are interested in the concept of blockchain and in its early adoption. And this event is organized in collaboration with our friends at Zeef, and this is our fifth webinar together with Dr. Ravi Chamria. And this is the fourth webinar in terms of the DeFi series. And today we are going to continue the topic of the DeFi use cases. And without further ado, I am going to invite Dr. Ravi Chamria. Hi, how are you?
Yeah, hi. I'm doing good. How are you?
Me too. Yeah, thank you so much. So glad to see you again and again on our platform. Thank you so much for coming. And let's try to share your presentation or screen. And
Yep, sure.
after we will able to see it, we will good to start. And in the meantime, I'd like to remind everyone to leave your questions in the live chat, wherever you are watching it. And at the end of our today's session, we will go through the questions from the live chat. So I think we can now see your presentation. Could you please try to make it full screen?
Yep.
Yeah, sure. So it works. I think we are good to start. Good luck.
Thank you. Yeah, hi everyone. My name is Ravi. I'm the co-founder CEO of Zeev. Zeev is a Web3 infrastructure as a service platform, providing rollups as a service and node infrastructure as a service. Today, this is the last webinar in the series of DeFi webinars, and it has been a very good response for the initial set of webinars. Just to recap, in the initial webinars in the DeFi series, we covered first, the concept level, what is decentralized finance, how it differentiates itself from centralized finance, what are the benefits, challenges, and some of the key players. And then, we also talked about the core components, the infrastructure components of decentralized finance, whether it be blockchain, you have smart contracts, you have stable coins, transactions, atomicity, etc. And then, in the third webinar, we talked about some of the key use cases. And today we are going to cover some of the other use cases for DeFi. So today, what we are going to cover are tokenization, which again, and with a more focus on real world asset tokenization, stable coins, derivatives, prediction markets, and insurance. So first, let's start with tokenization. So I think I'm sure everyone has been aware of NFTs, non-fungible tokens, and we in one of the previous webinar we talked about different token standards, what NFTs are, and so on and so forth. So NFT was a craze about two to 3 years back. A lot of digital collectibles were tokenized in the form of NFTs, and then NFTs matured further with dynamic NFTs and a lot of loyalty and fan based tokens, social tokens, and various kind of avatars. NFTs took. So NFTs again stressing the hype. Besides the hype part, from a tech perspective, from a concept perspective, NFTs are one of the coolest um, option that blockchain gave to the market. With NFTs or with non-fungible tokens, you can actually own an asset in an absolute manner. You can take the custody of the asset as a owner, which is not the case with any of the offline or digital assets managed by different intermediaries. Now, extending that the use case, now for last 1.5 years, we are seeing that NFTs have evolved further, and people are talking about tokenization of real world assets. So, what is tokenization of real world assets? So, we have assets in the form of either physical assets like real estate or physical art, and we have digital assets. It may be bonds, it may be carbon credits, it may be treasuries, it may be a portfolio, loan portfolio, or stock portfolio, or fund portfolios, right? So all these are different kind of assets, and there are $1 trillion worth of assets across different asset classes. So when we say tokenization, what we are doing is, again, like NFTs, we are creating a digital replica of assets, tokenizing them, putting them on the blockchain, so that the entire history, you can see the ownership of the asset, you can see all the transactions, the buy and sell transactions, and through a smart contract, you can actually, or blockchain ledger, you can draw out a complete asset registry. So the pieces are pretty much the same that what we see in the offline asset management, but now all the assets are being managed using smart contracts. So the process of taking an asset, creating a digital avatar on blockchain is called tokenization of asset. Now there are two kind of tokenized assets today. So one are the kind of description which I've given, which are called where you create a digital replica of an asset. So let's say there's a real estate property. So you're tokenizing that property or a portfolio of properties in the form of, let's say, a REIT structure. In that case, there are physical assets, and you are creating a digital replica uh, to which where the underlying asset is the real estate property. So these are called twin assets. So there's a digital asset, which is in the form of token, and then there's real asset, which is underlying it. And then the second kind of asset, tokenized assets, are native tokenized assets. That means you are creating the asset itself on the blockchain, for example, and it is applicable in some of the digital assets. So you're creating a new asset, and you are tokenizing that. If you see derivatives in the case of blockchain, or some of the stable coins will come to that, like DAI, etc., which are crypto collateralized, you can see it's pretty much the same concept, where the underlying asset is also a native asset to the blockchain. So there are a lot of players today who are focusing on native tokenized assets. So some of the different asset classes that are seeing the most traction today. One is the government securities, treasuries, bonds, etc. Then there are equities, corporate bonds, and private funds. Commodities like gold, silver, graphite, different kind of mining assets, real estate and land tokenization. Then fiat collateralized stable coins, USDT, USDC, etc. And asset-based finance, loan portfolio, or different kind of assets that can be tokenized. So in last 2 years, we have been seeing a lot of experiments, a lot of launches, production launches, as far as real world asset tokenization is concerned. So it's not something which is theoretical or conceptual at this stage. There are actually millions or billions worth of assets that are being tokenized on blockchain. There are quite a few players, for example, Securitize, who are tokenizing equity, and Bitbond, who are tokenizing bonds and creating a mature secondary marketplace. There are various blockchains which are focusing on real world asset tokenization. Two of our partner blockchains being, one is DCOM, which is Australia based layer one blockchain focused on real world asset tokenization, and they are already uh, uh, you know operating in the ESG space with carbon credit tokenization, graphite mining tokenization, etc. And then there is Corium, which is again an enterprise grade blockchain focused on real world asset tokenization. And you can, and as you can see, these different players are using the public chain networks like Ethereum or Polygon or DCOM or Corium, and different kind of asset classes being private credit, treasuries, funds, bonds, carbon, real estate, etc. If you see from a market share perspective, so of course the largest is fiat collateralized stable coins, because stable coin is the heart and soul of DeFi today. So whether you see USDT, USDC, so they have become the intermediary token whenever you are transacting between two tokens. And then come the commodities being gold, silver, um, and mining assets and all different kind of commodities. Government security, treasury bonds, etc., are being put on blockchain. Still a very small number, but yeah, it's going to grow. and then asset based finance, real estate, and so on and so forth. So you see right now the numbers are less because these are all some initial launches, but this is a good start. And I think one of the reason why things have moved a bit slow in last 2 years is because of lack of regulations. Because when we talk about real world asset tokenization, one of the most important pieces, because in most cases the especially in the digital twin kind of tokenized assets, there's always a real world asset, and it is being managed to a large extent in the traditional way. So there needs to be proper regulations that can that need to be brought into the whole tokenized asset marketplace, so that more and more tokenized assets would be there. And good thing is that this has just started happening. Some of the countries like UAE or Switzerland, some of the other European countries, and then few other countries, they have come up with the first draft or the first phase of regulations for tokenized assets. And that I think is has helped create some of these production use cases. So from a tech standpoint, there is no challenge anymore. The technology is quite mature, the process, the workflows are quite mature to enable real world asset tokenization. What I think is required is more mature regulations. And I think as these regulations are coming in, I believe that 2024 should be the inflection point where this whole tokenization market can explode a big time. So I think this is the most appropriate time to get into real world asset tokenization, either as an asset owner or as a business opportunity, as a startup, or various other means. So what are the benefits that asset tokenization offers you? So one, of course, is liquidity, because when we talk about tokenization of assets on blockchain, that means we are inheriting all the benefits of a blockchain protocol. So let's say if you are tokenizing assets on Polygon main chain or a DCOM main chain, then in that case, there's no restriction. Anyone can come in and trade into those tokens. So that way, you are creating a much larger market for the asset. So one of the challenge, and I think the biggest challenge today in the traditional asset management, is the illiquidity. Because of the smaller market, only the larger players are able to participate. Most of the asset markets are outside the purview of or access to retail traders. So geographical restriction, um, people who can participate in the trading, etc., leads to a illiquidity in the traditional asset market. So liquidity is one of the biggest challenge that real world asset tokenization is solving. And then accessibility, because they are global in nature. Of course, regulations, etc., would be there as to who all can participate, but and that again would be driven by smart contracts. So within the purview of the regulations and compliances, it opens up the market, and more markets can easily participate, adding to accessibility. Settlement efficiency, because there's a faster settlement. There's no back end infrastructure as we see in the traditional finance today. There's always a back end infrastructure. Like you go to ATM, you withdraw cash. It seems from a customer standpoint that you are doing a real time transaction, but that's not true. Let's say you're holding a card of your bank account, and your debit card is belongs to bank A, and you go to ATM of bank B and withdraw. There is a elaborate settlement cycle at the back end, right, which manages this transaction. And this backend infrastructure is quite old and quite sluggish, very expensive to manage, and so on and so forth. That adds to the cost, and that cost is passed on to the customer. So I think by bringing in more efficiency, by faster settlement cycles, it will reduce the operational cost, reduce the management cost, cut down a lot of intermediary cost, and ultimately it will benefit the customer. And then like as I mentioned, you inherit the benefits of blockchain. So you get more transparency, composability. Like the smart contracts bring in composability, so you can actually combine different options. So for example, let's say you create a tokenized asset. You have tokenized a real estate, or you have tokenized a bond. Now that's a tokenized asset. Now there's a decentralized exchange which has got and this tokenized asset is following one of the standards. Um, a token standard. Now you go to a decentralized exchange, people can actually use ERC20 token like a stable coin, USDT, to buy your token. So that is where you can you follow a certain standard to tokenize your asset, and you easily become part of the ecosystem. And other token standards, other tokens you can easily trade with. Similarly, you can interact with other smart contracts, and the kind of detailed discussion we had about the atomicity and how composability works in smart contracts, we actually take benefit of that. And then interoperability. So interoperability is something which has been one of the hottest topic in 2023. We see some players like Layer Zero or Router Protocol, which is an upcoming protocol for interoperability, and various such players. So they are bringing interoperability. You can interoperate assets, messages across different blockchains. So that again, I think is going to change or I would say that again was one of the a core challenge when we talked about real world asset tokenization, and that has been solved to a large extent. um, Various platforms for trading tokenized assets. So there are various platforms which allow you to tokenize. You can create your own tokenization platform, or you can use some of the SaaS platforms for tokenizing your assets. But once you have tokenized, there are quite a few exchanges or platforms which allow you to trade the tokenized funds. And these are some of the platforms where different kind of assets are being traded. um, this is the typical architecture of a tokenization platform. Just to simplify, rather than getting into the complexity of it, so you have an asset, you need to have something like a proof of asset where you are securing the underlying asset. Based Once you have secured the underlying asset, then based on verifiers who prove the ownership and the availability of the asset, based on that you create a tokenized asset. And then using the tokenized asset, you can use different decentralized oracles for price discovery. Let's say you are tokenizing gold, so you can use a decentralized oracle to pick up the price from LBMA or any kind of London Bullion Exchange or other exchanges, right? And plus there is a KYC module to ensure that all the users are following the KYC AML guidelines. And within the smart contract itself, you can define who all can trade into this asset. So let's say if you want to exclude certain geographies or certain set of people, you can do that. So so basically now the smart contracts and the overall workflow has matured enough to enable tokenization, meeting all the compliances and the regulatory guidelines. So that was tokenization of real world assets. As I mentioned, it's a very interesting piece, and I think you will hear more and more about real world asset tokenization in 2024 and 2025. Now, the second topic that we are going to cover is stable coins. So, stable coins, as you know, that most of the assets, the utility tokens, as we call them, whether it be Bitcoin or Ethereum or AVEX, these are all utility tokens. Utility tokens have been volatile, and we have seen because of a small market size, there's a higher volatility. Now, if you want to realize a market like DeFi, if you want to create a market like DeFi, you want finance to happen in a decentralized manner. Of course, it creates a lot of risk. Similarly, if let's say from an enterprise standpoint, if you are running a B2B use case, if you are trying to implement blockchain in a supply chain use case or a trade finance kind of use case, so volatility of the currencies is not cannot work, because you set the price or set the contract at a certain price, and the value of that asset itself changes by the time the contract is completed. So it is not acceptable in the business scenario. So seeing all these challenges, the concept of stable coin came in, a token which is stable in nature, the value of token which does not change. And I think the first and foremost were the fiat backed tokens. And what fiat backed stable coins are, that there is a fiat. So let's say US dollar based stable coins. So there's you deposit $100 into the bank account or into the pool, and based on that, 100 tokens are generated out of the blockchain. And the reverse process also happens. If you withdraw the funds uh, out of the pool, then 100 tokens will be burned. So stable coin has got a process by which, adding the funds to the pool, you generate the exact same number of tokens, and you burn in the reverse process. So that is what a stable coin is. And using stable coin in DeFi, enable in DeFi all the transactions, or you can say the storage currency has become a stable coin. So it has become the most backed asset, and as you can understand, it is very much required in all kind of decentralized financial transactions. And at the same time, it is also enabling some of the large B2B use cases. So, what are the different kinds of stable coins? So, the most easily understood and the most common today is the fiat-backed stable coins. So, we have USDT, we have USDC, BUSD, and quite a few. In fact, PayPal also launched uh, their stable coin. So, these are fiat-backed. So, they are pegged with a fiat currency like US dollar or euro or Australian dollar, Singapore dollar, etc. And the price of the stable coin does not change. The second is non-collateralized or algorithmic stable coins. Now, the concept of algorithmic stable coins was that the stable coin, the value of stable coin, let's say $1, is controlled by an algorithm. And what that algorithm does is that if the price of value of that token, let's say, goes above $1, so you can reduce the supply of the token in the market. So once the supply is reduced, the price will go down. And similarly, if the price has gone down, you can increase the supply, so the price will go up. So basically, you are using an algorithm, and there's a buy and sell process based on which the price of the stable coin will be stabilized to $1. But it would not be exactly $1 like what happens in the case of fiat backed stable coin. But yes, based on algorithm, it strives to retain it. Terra was one of the biggest algorithmic stablecoin. Unfortunately, it failed a year back. But yeah, algorithmic stablecoins is a very interesting concept, and there were some challenges as far as Terra is concerned in terms of how to manage the liquidity and what is the breaking point for this buy and sell algorithm. So as we are going to see, there will be more maturity that will come to this product, and we are going to see algorithmic stable coins in future. Uh, yeah, with some changes which actually cause the challenges to Terra. Then there are cryptocurrency backs. This, I think, is the second most popular category today, which are crypto collateralized stable coins. So DAI by MakerDAO is one such example, and synthetics. So there, what happens is the cryptocurrency itself acts as a collateral, and based on that, a token is generated. And DAI, the value of DAI remains as $1. It is managed by the organization called MakerDAO, which is again a DAO-based organization which manages DAI. And then, commodity collateralized stablecoin. This is something which is now picking up, like Paxos Gold, which is gold backed, or Tether Gold. And then we are going to see some other commodities coming into picture, and we are going to see. So this is something which is going to increase over a period of time, not in uh, available in the public domain as such, or not many retail takers as of now. So right now, I think fiat backed stablecoin has got the bigger share. So if you see Tether, USDC, these are the two stable coins which are fiat-backed stable coins, and they have got the largest market share. And then comes DAI and True USD, Binance USD, etc. But DAI is at the third number, which is crypto collateralized stable coin. So difference between now, so what has happened is like we have stable coins in the DeFi market. you know they are primarily operated by private players like Circle or Binance or PayPal. So they are organizations who are launching these stable coins, and they manage the funds, the underlying asset is US dollar in the case of USDT or USDC. So they manage the pool of that. So of course there's a risk that if the underlying asset is not there, or mishandled or mismanaged, then there's a risk to the price of the stable coin itself. That is why now, especially what happened with a centralized exchange like FTX, more and more people are opening up how to bring in a better visibility into the underlying asset. So there are concepts of proof of assets or proof of reserves, showing that what kind of reserves you are holding, and the circulating tokens in the market should actually match one to one with the underlying reserves, or underlying reserves should be more than the tokens in circulation. So that way, the value of stable coin, especially the fiat-backed stable coin, should always remain one. Um, but yes, they come under the purview of cryptos, and so some kind of regulations, etc. Some challenges are there from a regulatory standpoint. But now, as you know, we have seen player like Circle or PayPal, which are traditionally some of the largest fintech companies in the world, traditional fintech companies. So when they got into this space, they brought in a lot of compliances and adherence to regulations, etc. So yes, the market has become much better as compared to what it was 2 years back. Vis-a-vis that, some of the central governments are also coming up with the concept of CBDC, which are centrally bank issued digital currencies. So they again call it stable coins because all the CBDCs are going to be pegged to the currency of the state. So let's say if US government launch something, or Japan government or European government, so it may be back to euro or yen or US dollar and so on and so forth. So CBDC is something which is our initiative taken by the government. Central banks are issuing these digital currencies in the form of CBDCs. Again, the concept is it's stable coin, it is blockchain driven. So from a tech standpoint, they are very similar to stable coins that like USDT or USDC. But again, in this case, the government is or the central bank is controlling the supply, or the minting of the tokens, etc. And there is no underlying asset in this case. Like traditionally, we have seen the currency managed by the government does not, may or may not have sufficient underlying asset to cover that. Same goes for CBDCs. There's no backing of the underlying assets in this case. So the challenge with CBDC is that it can be powerful depending on the fiat currency of that country, right? So as powerful, like US dollar is very strong, euro is very strong. So of course, a CBDC based on these currencies will be strong. But if the underlying asset itself is not very strong, CBDC may not be that strong. Vis-a-vis that, in the case of DeFi-based stable coins, they are they have chosen only stable currencies like US dollar or euro or few other currencies, right? So uh, that way, they have a much better adoption. CBDCs is something which is now quite a few countries are building CBDCs. So we may start seeing some projects coming into the market and people start using it. Initially, most of the projects that I have gone through are they are using it for wholesale transactions, not on the retail side. That's why on the retail side, we do not see many of the CBDC projects coming into picture. So that was a brief about stable coins. Just give me a second. Now, coming to the topic of derivatives. So derivatives are pretty much like the traditional derivatives. So what is a derivative? It's a contract which derives its value from an underlying asset. And that underlying asset may be an exchange, it may be an index, like we have seen, index based derivatives in the stock market. The underlying asset may be an asset itself, right? So these are derivatives. And the concept of derivatives always came in to, hedge the price risk. So you are not dealing with the underlying asset itself, but you are dealing with a derivative of that asset. So you're not directly getting involved in the asset itself. Let's say you want to speculate on the price of an asset or price of an index. You don't need to invest into the index or an asset. You can invest into a derivative which has got that asset or index as an underlying asset. So the concept of derivatives came to DeFi. Like we have spot pricing, spot trades on exchanges. Similarly, derivative exchanges also came in, which allow you to speculate on the on different derivatives or different underlying assets. So derivatives is definitely a much bigger market size because here you are like vis-a-vis the spot market or a stock or bond market. It's a very huge market because you can create derivatives for any kind of asset or index, and that way, and plus, you do not need, you are not actually, so for example, let's say there's a stock, the cost of that stock is, let's say, $300. Now if you want to buy 1,000 units or 10,000 units of that stock, you will require millions of dollars, right? But vis-a-vis that, if there is a derivative on top of that, uh, you can simply, based on derivative, you can put in a price as to the increase or decrease that will happen. And so what you're working is not with the underlying asset, you're not buying it and selling it to create a margin, but you are simply operating in the derivatives, and based on profit or loss, you settle it at the end of the end of the cycle. So if you see from a centralized derivatives, there's an elaborate structure, there's a backend infrastructure, there are governance and compliances, there are merchant clearing and settlement members which are there, the settlement bank, clearing houses. So there are a lot of intermediary players which enable a centralized derivatives. Vis-a-vis that, DeFi based derivatives are again smart contract based. There may be a governance which is DAO based, and then there are buyer sellers, and then there are collateral providers who are providing the collateral. Derivatives are create and they create the derivatives on the smart contract, and the buyers and sellers can actually start putting positions on these derivatives. Some of the examples: DYDX is one of the largest decentralized derivatives, and then GMX is the largest DeFi derivatives platform. Current TVL is almost 537 million. It supports swap, supports zero price impact trades, and so on and so forth. Synthetics again is you can create on-chain synthetic assets, um, which has got an underlying asset, which are the real world assets. So this was I just quickly covered on the derivatives because this is something, a difficult topic to understand. But if you already understand the traditional derivatives, it's pretty much the same in the case of DeFi. The the best part is the benefits are that since it is based on smart contracts, it cut down a lot of inefficiency, the cost due to inefficiency, like the cost of settlement, cost of managing the assets, creating different intermediaries, etc. So they are very cost efficient, the fee is very less, and the market is global, so higher accessibility, much better liquidity, and so on and so forth. Now we come to the fourth topic, which is the prediction markets. Again, a small topic. So what prediction markets are? So prediction markets have been again very similar to derivatives when we talk about assets. So there are based on an event, you basically predict the outcome of an event, and so there is, you are saying, let's say that event is going to happen, and there are people say that event is not going to happen. So there are two parties, and they speculate on something on the opposite side, and they put in the stakes, and the person whose outcome is actually matched with the outcome of the largest set of people uh, wins the stake, and other one lose the stake. So that is how the prediction markets happen. Initial idea of prediction markets was again hedging the risk. So let's say you operate in oil, and you know that the price of oil is going to increase. So you may put a buy order today, that in future you are going to buy this much oil at the current rate, right? So that way you are hedging the risk. It may be possible that in later date, in future date, the price of oil, rather than going up, may actually go down. Then you will make a loss, but at least you are hedging that based on the current pricing, which is ideal based on your calculation of margins, your operations, etc. You are okay with that. So that's how you hedge the risk on the underlying asset. The hedging of risk happens in the case of forex markets, it happens in all of commodity markets, and so on and so forth. So that is what prediction markets came in. So in the case of prediction markets, there's a large group of people who are participating in this. So it's also called a wisdom of crowd, and but it works very much like, where different participants come in, and there's a speculation that happens, and based on the actual outcome, there's a risk or reward. What are the advantages of DeFi based prediction market? So uh, the centralized prediction markets again are being driven by centralized players. There's a larger cost, a larger fee, etc. In the case of DeFi based prediction market, one, there's a higher accessibility, so it's free and open, anyone can participate, so it opens up the market more. The number of participants, of course, it improves the prediction itself, so it makes the market more accessible and much better. um, you can create your own markets, so it's smart contract driven. You can actually create your own market if you want to do that. If you want to do that in a traditional prediction market, it's going to be very expensive and time driven exercise as compared to a DeFi market. And there's lack of intermediaries, so much better settlements, much better efficiency, so reduce the cost and improves the liquidity. So this is how a decentralized prediction market work. So there's, let's say, user one, which is asking a question. User, there are users who are betting on the correct answers, and then there are counter claims. Who would put in a stake against the people who are betting on a certain correct answer. Now, depending on the actual outcome, the tokens may be burned, a stake may be lost for one set of users, and the other set of users will win the tokens. They will get their stakes back, plus they will earn a profit out of this. And the whole outcome is saved in the blockchain ledger, and the whole process is driven by a smart contract. So some of the Augur is one of the earliest player in this market, uh, and and then there's a Poly market, which is a decentralized prediction market on Polygon, and then similarly there are different other prediction market platforms today. So this is the last topic for today, which is insurance. Again, covering in just brief. So insurance, as we know, like the traditional insurance works. So there's an insurance which has got a certain terms. Uh, it defines all the risk and what the premium would be based on the risk involved, and what the payouts would be. Again, what are the criteria based on which the payout is going to happen. So, blockchain has been seen by the insurance industry. In the traditional insurance, also how to use blockchain or make it more smart contract driven. One is to how smart contracts will enable instant settlements. So that is definitely one value. So there are two kind of approaches that have been taken in insurance. One is blockchain based insurance, how taking the traditional workflow, traditional products, and using blockchain for that insurance. So um, I was involved in one such exercise about 3-4 years back for weather-based crop insurance. Now, typically in a weather-based crop insurance, what happens is that there is the insurance policy which has got certain criteria, that if, let's say, um, the rainfall is going to be less than 2 mm for a consecutive 15 days, right? Or let's say there is some risky event, maybe a precipitation or wind or something which can destroy the crops. So these are some of the risks which are defined. And the beauty of weather-based insurance is it is one of the parametric insurance product. Parametric means that there is a data, it is parameterized, it is quantified, so risks are not subjective. um, so it's easy to figure out that when the claim becomes due. So in weather-based crop insurance, you can have all these criteria into a smart contract, and then farmers can take a policy, and then there are IoT workstations across different regions or farms, and then they pick up the weather data and the local regional weather data from these farms, and these are data is brought into the smart contract using a decentralized oracle. Now, based on the data that happens, The smart contract can see if the rainfall has been less than 2 mm for consecutive 15 days. It will automatically create a claim and settle the claim in favor of the farmer. So you cut down, you increase the speed, you cut down a lot of process. Farmer in fact does not need to even apply for claim. The claim can be automatically settled based on the actual data coming from the IoT devices and the decentralized oracle. So that is how, so that is one. In the traditional finance, blockchain is being used for parametric insurance products. There are various other parametric insurance products, like which are binary products. Event happened or didn't happen. Based on that, a certain claim becomes due. The second area, which is a completely decentralized insurance, it a bit different. In decentralized insurance, especially in the DeFi, is how to make the insurance completely decentralized. So, as we discussed in the last webinar about how a decentralized exchange or a decentralized lending protocol works. Again, decentralized insurance also works based on a smart contract. So there's a protocol governance operated by a DAO, and then there are capital providers who are providing capital into a pool, into a smart contract pool. And then on one hand, you have people who are paying the premium, getting insured. So it's like buying an insurance policy. And then there are underwriters who are, or verifiers who are going to verify the claim, and the smart contract will settle the claim. So decentralized insurance today is being used mainly in the DeFi world, like smart contract hacks. We have seen a lot of smart contracts hacks or exchanges hacks, wallet hacks that have happened. So how to insure against them? One, of course, is writing a proper smart contract, getting it audited by different smart contract audit companies, and the third piece is to take an insurance. If still something happens, the funds are lost, you can still cover part or most of the funds using a decentralized insurance. There are various kind of DeFi insurance pools. There are protocol specific insurance, which are specific to a protocol. So any kind of hacks or smart contracts or issues or in wallets, etc., happen within the protocol. There are aggregator insurance pools, which basically covers smart contracts, etc., across multiple pools. And then there are various other insurance pools. Some of the top players in the insurance are Nexus Mutual, which basically ensures the smart contract hacks, any bugs or risk that can be covered using Nexus Mutual. Some kind of multi-sig wallet issues, DAO hacks, etc., can be easily covered using Nexus Mutual. Other players are Insurace and OPM Finance. So this is pretty much, I wanted to cover some of the other topics. We, of course, gave a lot of time to some of the key DeFi use cases like lending or decentralized exchange, NFTs, etc. Today, I try to cover a lot of ground, a lot of other use cases into one tightly packed webinar. But I hope I've been able to, you know, provide you some details. But you can definitely go back. There are a lot of data, a lot of videos which are available on the internet that you can go through, understand. You can check out some of the leading players. You can go to a site called DeFi Prime that provides you different DeFi players across different categories. You can go to DeFi Llama, and there are various other such platforms where you can get a lot of information about what is happening in the DeFi world. And as I mentioned, Zeev is a Web3 infrastructure as a service player. If you are looking to start your blockchain journey, building something in DeFi or any other kind of decentralized application, and you do require rollups or your custom blockchain or app chains or node infrastructure or RPC APIs, you can always connect with me or log on to Zeev and connect with us. Thank you.
Okay, thank you so much for such a great presentation. And we received a handful of questions, and let's start one by one. So the first question says, could you explain how tokenization in DeFi differs from traditional asset tokenization?
Yeah, so in DeFi, as I mentioned, what we are trying to do is one, we are bringing trust and transparency using blockchain. Second, we are using a token standard. And the value of token standard becomes very important when we want to have an interoperability of assets. Today, assets in the traditional finance are being tokenized using different kind of, and what we mean by standard. So standard is a token has got a metadata, right? Now, this metadata, if it's not standardized, these two different kind of assets, they are not interoperable. Their databases are different. They are managed differently. If you want to exchange between these two tokens, you cannot do that. DeFi again brings in a defined token standard and interoperability among the different assets. Like I gave an example, you can actually create a tokenized asset using one of the asset token standard, and then you can people can buy using USDT or any other ERC20 token. They don't need to do anything. It's by default. Since you are following the standard, it's interoperable or tradable. Then, in addition to that, as I mentioned, once you tokenize on a blockchain-based token is a token which you have an absolute custody of. So, if you are holding the token in your wallet, you have an absolute custody. Nobody can take away that token. Second, all the transactions that you do, there's an immutable audit trail, a historical audit trail of every asset, every transaction pertaining to an asset. So this again brings in a lot of trust and transparency. um, I know one of the hard fact that most of the cases today, if you see in the courts of law, are related to the ambiguity on the ownership, especially when we talk about inheritance related properties and various other assets. There are a lot of lawsuits, a lot of challenges today to ascertain the rightful ownership. So tokenization of an asset actually, DeFi based tokenization brings that piece also. And then some of the other benefits by creating these assets on blockchain, you have more participation across geographies, that leading to higher liquidity, better settlement cycle, so lesser cost, and so on and so forth.
Okay, thank you. And I would like to also remind that we had a separate webinar dedicated to tokenization of real-world assets, also with Dr. Ravi Chamria. And please have a look and find it on our YouTube channel. And the next question, what are the initial steps and challenges in tokenizing real-world assets in DeFi?
Yeah, so I think the most important challenge, of course, is the regulatory and the compliance, because when we are talking about real world asset tokenization, there is always a real world asset which is underlying the entire tokenized asset, and and they are governed by the current set of regulations. So there needs to be a proper regulation for digital assets. How they are going to purview, whether from a taxation perspective, whether from tradability perspective, whether from asset registry, how the ownership of the asset is going to be managed or proven. So these kind of regulations and compliances need to be there. So that, I think, are the initial set of challenges. As far as the workflow is concerned, I think there were a lot of technology challenges in terms of how to design a tokenization platform, which I believe is something, a thing of the past today. A lot of robust and mature tokenization platforms are there, and as I mentioned, gave some examples. There are quite a few blockchain protocols itself who are focusing on real world asset tokenization. So they have created, like DCOM, I gave an example, which has created a lot of core components. So for example, when you are creating a tokenized, you require decentralized identity, because you want to combine the cryptographic identity, your wallet ID, with a real world ID, right? So that your real world ID can be used by the smart contract to see whether, based on compliances, can you participate in that token or not. Like for example, you are launching a tokenized asset, and only accredited investors are allowed to participate. So based on your profile, which is a real world identity, that needs to be combined with the cryptographic identity. Similarly, you require decentralized oracles, you require proof of reserves, basically some way where you map this underlying asset very tightly coupled with the tokens that you are generating. So there should be a proper, well-defined workflow with third-party auditors and verifiers to ensure that whenever a new asset comes in, the tokens are generated. Whenever the asset goes out, the tokens are burned, so that the actual circulating supply of the token always matches the underlying asset one to one. So
Oh,
these are, I would say, the initial steps and challenges.
okay. And so a question from me, clarifying about this compliance topic. So when you say about compliance, I believe it's going to be something with governmental regulation, of course. And what are the good examples of good blockchain compliance or DeFi compliance in the world?
Like you mean which countries have launched
Yes,
the?
yes.
Yeah, so I know Switzerland has got some mature digital asset regulations. Dubai has come up with Dubai UAE has come up with VARA again for digital assets, and then there are quite a few. I'm not very well updated on what all jurisdiction, but I know quite a few European countries are coming up with compliances. They may be in pieces, like they initially the compliances may be only for digital assets like real world asset tokenization, and but still I believe that more and more jurisdictions are going to come up with more mature regulations which will cover the utility tokens and other kind of tokens also.
Okay. And next question. So, what makes a stable coin decentralized? And can you provide examples of successful decentralized stable coins?
Yeah, so that I think is definitely an interesting question. So like if you talk about fiat stable coins, yes, it is partly decentralized in the sense that the token is residing on blockchain like USDT or USDC, but the underlying asset is still residing with a private organization. But yeah, if the private organization itself is being well regulated, there is a proper proof of reserves. There's a data on chain about the reserves, the handling of the reserves, the changes in the asset, the underlying reserves. If everything is on chain, I would believe that slowly and slowly these stable coins will become more and more decentralized. So this I would call as stable, decentralized stable coin. The other, as I mentioned, one was algorithmic stable coin, which again is based on an algorithm deployed on the blockchain. So based on how the price, and you're bringing the price from a decentralized oracle. So based on the change in the price, the algorithm will ensure that the price stabilizes. And the third, we talked about crypto collateralized like DAI. So DAI, I would call it completely decentralized stable coin, except for, of course, the DAO. There's a DAO which is uh, has got the rights to make changes to the smart contract itself. But if you ignore that piece, then pretty much what is running on the blockchain is completely decentralized.
Okay, and the next question, what are the major challenges that central banks face in implementing CBDCs, and how might these challenges be addressed?
So, frankly, I'm not a subject matter expert on CBDC. I have not delved much deeper into CBDCs, but I think the initial experiments with CBDC are largely, for interbank transfers or transfer between bank and the central bank, or in the wholesale market. So CBDCs have still not come into the retail markets for the users to experience. But I think in 2024, some of the CBDC projects may come into where we as users, retail users, can actually see how CBDCs are going to operate.
Okay, and next question is also about CBDCs, and it says, "What is your perspective on the future development of CBDCs? Do you see them coexisting with stablecoins, or will one dominate the other?"
So difficult to say. Again, I would not comment much on the future of CBDCs. It again will depend on the if CBDCs inherit all the challenges with the traditional currency, then I think that would not be good for the future of CBDCs. If they not just take the technology, which some of the projects they are just taking the blockchain technology, but pretty much inheriting all the challenges with the traditional currency. If they improve like a digital money and they bring in more trust and transparency, and there is some transparency on the underlying asset, how new tokens are being minted, whether tokens are getting out of circulation based on the usage. So if some changes need to happen in the traditional currency market, due to which the whole concept of Bitcoin came in. So if those are not solved, I think CBDCs will not able to see the right impact, or will not be able to make the right impact that they are supposed to make. So I believe as far as the Web3 world is concerned, I believe the stable coins will still be more adapt. Yes, with more regulations coming into, more compliances, like I mentioned about proof of reserves, etc. But I believe they still will continue to enjoy the majority.
Okay, and I believe that was the last question for today. And I think that's the right moment to conclude our today's webinar, and not only the webinar itself, but the series of 4 sessions dedicated to DeFi and hosted in collaboration with Ziv and Dr. Ravi Chamria. First of all, I'd like to thank you, Dr. Chamria, for being with us throughout a long, long time. And I'd like to thank everyone for coming and watching today's episode. And if you'd like to find out more, just go to our YouTube channel or our website to find the recordings of our previous wonderful sessions. And I think that's it for today. And for this year, we are not going to host any webinars until the end of the year. And thank you once again. Thank you, Ravi, and stay tuned. Bye bye, everyone.
Thank you.